Hello everyone. We hope you had a wonderful holiday season and we hope that this year is off to a great start.
We're going to be presenting Outlook 2021. Stay tuned.
Now that this year is here, it's time to look forward. Things are going to look different. They're going to feel different. 2020 has changed us in ways we not only do business, but the way we connect. It was a very unusual year because not only did we have the elections to deal with, we had the 100-year pandemic. And so, what LPL Research has put together in Outlook 2021 are their thoughts regarding the stock and bond market, the economy, and the post-election policy environment. Jim and I will cover this. I'll do the first 4 or 5 minutes, and then Jim will finish up. We'll try to make this as brief as we can and to the point. Now, historically, a split Congress has been very positive for stocks. As it's recording, it's likely that's what we'll have. This data is taken from 1950 through the end of 2019. You can see the split Congress certainly has given us the best returns over other years in which one party had total control. When we look at the expansion, the question is, how long can this expansion last? Well, we have to look at when it started, which was probably 7, 8, maybe 9 months ago. But we witnessed one of the steepest declines in stock market history, where the market went down just about 35% within a matter of about 5 weeks. Now, the response to this by the Federal Reserve and Congress was swift, and it was big. They knew a recession was coming. It's the first time we actually knew a recession was coming, for sure, because we basically shut down the economy in reaction to the COVID-19. And so we had the advantage of knowing the economy was going to go into recession. Therefore, the amount of stimulus that was put into the economy was more than twice the amount that was put in during the financial crisis in 2008 and 2009. So the recession was caused mainly by the government. The government knew that. In response to COVID-19, they then put a lot of stimulus in. The record amounts of monetary and fiscal stimulus has been firmly in place, and we now have vaccines. We believe all of this is going to really show towards the middle of this year, and we're going to see hopefully a really good second half of the year regarding even the economic data that will come out. And here we have an average expansion that lasts a little over 5 years if you go back to 1945, but we think because of all the stimulus, it's fair to say this expansion may last longer. We can see historically some have lasted longer than 5.3 years and others lasted less. But because of the response, we think it'll be a good expansion. But anticipate the stock market is different than the economy, and it'll be volatile. And so you have to decide, if you're going to stay in it for the long haul or not. If you act emotionally, then you're going to experience problems. So make sure you're comfortable with your exposure to stocks and bonds, and then stay the course. There was a lot of talk about the type of recovery we would have. Some thought it would be a V-shaped recovery. Regarding the stock market, it really was sort of a V. But as far as the economy, not a V. Some thought it would be a U-shape, and it wasn't a U either. Some refer to possibly a K-shaped recovery, and this is what it appears to be right now. And hopefully it might change, but what we have is a widening between the gap between the haves and the have-nots. As we look at the low wage unemployment rate, you can see it's gone up significantly, while the high wage unemployment rate has gone down significantly. So, we're seeing areas, some of the service areas, the restaurants and the travel, the hotel, they've been hit hard, and those workers have been hit hard. You look at technology and some of the manufacturing areas, they're flourishing and they're doing fantastic. So again, it's just sort of a widening gap between these two, which is not good, and long term it's not good. We'll just see how it plays out. Now, when we look at growth, the positive is this year we should see a lot of growth. In the U.S., we're looking at 4 to 4.5% growth. Developed international countries will lag behind, but there'll still be good growth rates there. Emerging markets are going to be the best, and that's largely due to China and their explosive expansion. So we're looking at emerging markets. They have growth rates of about 5 to 5.5%. So global growth rates this year projected to be 4.5 to 5%. It could even be greater, again, if that second half of the year turns out to be as good as some people believe. And then when you look at inflation should remain low, under 2%. Unemployment continues to trend down. So, and Jim will get into some other information, but so far it looks like 2021 is going to turn out to be a pretty good year.
Switching gears here, my dad, Jim Sr., spoke about macro trends, and I'll be discussing the stock and bond markets more specifically. We'll try to keep my presentation to 5 minutes as well. So just to jump into it, we know how difficult 2020 was for a lot of us. A deep recession, a bear market, the election. But 2020 has been a good year for stocks, which logically doesn't always add up. And it's really important to remember the stock market oftentimes is forward-looking, looking out 6 months or 12 months. And we certainly see more optimism with reopening and the economy getting back on its feet in 2021, 2022, and beyond. So turning our attention to the U.S. stock market, we see the headline, "Earnings Rebound May Fuel Solid Gains for Stocks in 2021." And we forecast the market potentially moving higher due to that strong earnings rebound. A bounce back in earnings would primarily be due to pent-up consumer demand, as well as cost efficiencies achieved during the pandemic. As my dad alluded to earlier, you would expect there to be a lot of economic activity in 2021 and beyond, which may allow stocks to grow into somewhat elevated valuations. We've seen S&P 500 target range between 3,850 and 3,900 in 2021, with potential for upside than expected vaccine progress. We estimate earnings per share of $165, leaving price to earnings ratio, or P ratios, higher compared to historical averages. But with interest rates likely remaining lower, and as we see the 10-year U.S. Treasury yield finishing 2021 in a range between 1.25% and 1.75%, with our bias leaning towards the lower end, it tends to be a catalyst for stocks and help justify higher PE ratios. New bull markets historically have been built on strong first-year gains. Now, historically, the worst economic conditions have been followed by some of the biggest rallies. And in 2020, the S&P 500 was able to fully recover its bear market decline in only 6 months, when it typically takes years. In fact, for the first time ever, stocks are in a position to produce a gain in a calendar year after being down by more than 30% at one point during that year. It's a pretty incredible recovery, and certainly not one that many expected earlier this year. After such a strong rally from March 2020 lows, it would be logical to think returns going forward may be muted. As we see in this chart, we look at some of those previous major bear market lows and see that stocks tended to add gains well after the initial surge. So moving on to the bond market. Typically, an improving economy leads to higher interest rates. And when rates go up, bond prices go down, which weighs on total returns for bonds. There still will be opportunities for bond investors in 2021, but it may be a year that requires greater patience, lower expectations, and a more opportunistic approach. So I mentioned that when rates go up, it's typically had negative implications for bond returns. From a historical perspective, the decline of the 10-year Treasury yields experienced from the end of Q1 in 2019 to the end of Q1 in 2020 potentially points to a meaningful increase in yields going forward. So looking at the chart, since 1990, we've experienced 6 yield declines of at least 1.5% over 4 calendar quarters, as this chart shows. In all 6 cases, the 10-year Treasury yield was higher a year later by an average of 90 basis points or 0.9%. So this certainly can be a headwind going forward for bond returns. And finally, our last slide, which shows the returns for the S&P 500, the Barclays Aggregate Bond Index, and U.S. Treasuries. What we see here is that despite lower return expectations, high-quality bond holdings may continue to play their role as portfolio diversifiers. During the 6 instances in which the S&P 500 declined at least 10% between 2010 and 2020, Treasuries typically led the way, with the Barclays Ag Index also gaining on average. So the key takeaway, even when positioning for a rising rate environment, exposure to core bond is important for diversification.
And with that, we'll wrap up our market outlook for this year.
We hope you enjoyed this short presentation. If you have any follow-up questions whatsoever, please don't hesitate to pick up the phone and give us a call. Thank you very much. And again, we hope 2021 is a very happy and healthy year for all of you.
Thanks, everyone.
Thank you for joining our Outlook 2021 discussion. Please review these important disclosures.